Asia's trading week opened with widespread losses, as investors woke up to a sea of red across major indices. Red arrows dominated screens from Tokyo to Hong Kong, signaling a sharp reversal from the optimism that had recently buoyed markets. A mix of troubling economic news and tech sector anxiety quickly erased the positive momentum of previous weeks, leaving traders on edge and searching for answers. The downturn wasn't triggered by a single event, but by a combination of Japan's weak economic data and global tech jitters, both of which weighed heavily on sentiment. Japan's disappointing numbers set a negative tone, raising doubts about the region's economic health and sparking fresh concerns about the pace of recovery. Investors reacted swiftly, pulling money from Japanese stocks and seeking safety in cash or more stable assets as uncertainty grew. Many also looked to traditional safe havens like gold and the US dollar, hoping to shield their portfolios from further shocks. Meanwhile, all eyes were on Nvidia in the US, whose upcoming earnings report cast a shadow over Asian tech shares and added to the region's nervousness. The question on everyone's mind: could Nvidia's meteoric rise continue, or was a correction looming just around the corner? This uncertainty, combined with Japan's woes, created a risk-averse mood that spread across the region, prompting many to rethink their strategies. While a few markets managed to resist the downward trend, the dominant story was decline, a stark reminder of how interconnected global markets have become in today's world. Bad news in one corner can quickly sour sentiment everywhere, amplifying volatility and uncertainty. The week began with caution, as investors braced for more volatility ahead, watching for any signs of stability or further shocks on the horizon. The main catalyst for Monday's sell-off was Japan's third-quarter GDP report, revealing a 1.8% contraction. This unexpected downturn caught many by surprise, as analysts had hoped for a more stable performance. While slightly better than forecasts, the drop marked Japan's worst performance since mid-2024 and rattled investor confidence. The economic landscape appeared increasingly uncertain, causing widespread concern. A shrinking GDP signals fewer goods and services produced, spooking both investors and business leaders. This contraction suggests deeper issues within the economy that need addressing. Tokyo's Nikkei 225 and Topix indexes both fell sharply, reflecting the sudden loss of faith in Japan's recovery. The market's reaction was swift and severe. Hopes that Japan was finally breaking free from stagnation faded, as the report highlighted ongoing vulnerabilities. The dream of a robust recovery seemed more distant than ever. When a major economy like Japan stumbles, the effects ripple through global supply chains. This can lead to delays and increased costs worldwide. For investors, negative GDP means lower profits and higher risks, making Japanese stocks less attractive. The uncertainty adds to the market's volatility. However, the weak data also lowered expectations for a Bank of Japan rate hike, offering a small measure of relief. This could provide some breathing room for businesses. Lower rates could cushion the blow, but the overall mood remained somber. The path to recovery appears fraught with challenges. The GDP shock underscored just how fragile Japan's recovery remains. It highlighted the need for strategic economic reforms. Investors were left searching for signs of stability in a turbulent market. The future remains uncertain, and vigilance is key. Japan's GDP slump was driven by two main factors: weak consumer spending and falling exports. Households, squeezed by inflation and stagnant wages, cut back on purchases, dragging down domestic demand. At the same time, exports, a key pillar of Japan's economy, fell due to higher US tariffs and softer global demand. This double hit left Japanese companies struggling to grow, with sluggish sales at home and abroad. The tough environment was already being felt by businesses, and the GDP data simply confirmed their fears. One bright spot: capital expenditure remained resilient, as companies continued to invest in future growth. Strong business investment helped soften the blow, but couldn't offset the drag from weak consumption and exports. The result: a clear signal that Japan's economy faces significant headwinds. Investors grew wary, questioning the outlook for profits and jobs. The market's reaction was swift, as caution replaced hope. Japan's challenges became a warning for the rest of Asia. Japan's economic woes were compounded by a sudden and high-profile diplomatic flare-up with China, adding a new layer of complexity to an already challenging situation. Tensions rose sharply after Japan's prime minister publicly suggested that a potential Chinese attack on Taiwan could directly threaten Japan's national security, a statement that drew a swift and forceful rebuke from Beijing, escalating diplomatic friction between the two countries. In response, China issued a travel advisory, warning its citizens against visiting Japan. This move was seen as a major blow to Japan's tourism sector, which had only recently begun to recover from pandemic-era restrictions. Chinese tourists are known to be big spenders, and the mere prospect of losing this vital group sent tourism-related stocks tumbling, with hotel chains, airlines, and retailers all feeling the impact. The diplomatic spat rattled financial markets in both China and Hong Kong, with key indexes falling as investors grew increasingly worried about the potential for broader economic fallout and disruptions. Worsening relations between Asia's two largest economies threatened not just tourism, but also trade, investment, and critical supply chains that connect the region. The travel advisory was just the first visible sign of escalating risks, hinting at the possibility of further restrictions or retaliatory measures in the future. Geopolitical tensions quickly translated into heightened market volatility, especially for companies heavily reliant on Chinese visitors and cross-border business. Investors scrambled to reassess their holdings, leading to a sharp sell-off in tourism and retail stocks, as uncertainty clouded the outlook for the sector. The episode served as a stark reminder that politics can move markets just as powerfully as economic fundamentals, and that diplomatic tensions can have real financial consequences. As uncertainty deepened, it added to the region's already fragile mood, leaving investors and businesses bracing for what might come next. Beyond Japan and China, anxiety swept through Asia's tech sector, all thanks to Nvidia. The US chip giant's upcoming earnings report had investors on edge, as its stock performance now sets the tone for global tech. Asian suppliers and partners depend on Nvidia's continued growth. Any sign of a slowdown could trigger a broad sell-off. After a massive run-up, many feared tech valuations were overheated. Memories of recent corrections lingered, and traders trimmed positions ahead of Nvidia's results. The fate of Asian tech stocks was temporarily tied to one American company. Until Nvidia reported, uncertainty kept buyers on the sidelines. The sector's fortunes hung in the balance, amplifying market nerves. All eyes were on Nvidia to see if the AI boom could keep powering ahead. Investor anxiety over Nvidia intensified after regulatory filings revealed major players were selling. SoftBank, a tech investment giant, exited its Nvidia stake entirely, a move that sent shockwaves through the market. Michael Burry, famed for predicting the 2008 crisis, took a short position, betting Nvidia's price would fall. Peter Thiel, another tech heavyweight, also sold his entire stake, adding to the bearish narrative. The actions of these high-profile investors suggested that even the smart money saw risks at current valuations. Their moves fueled fears that Nvidia's rally had peaked and that a correction was imminent. The news poured gasoline on already smoldering tech sector worries. Smaller investors followed suit, adding to the sell-off. The market interpreted these exits as a warning sign for the entire AI-driven rally. Caution reigned, with Nvidia's fate looming large over global tech. Amid the gloom, South Korea's stock market stood out, surging 1.7% thanks to its semiconductor giants. Samsung Electronics and SK Hynix led the rally, buoyed by reports that memory chip inventories were finally shrinking. Rising demand and falling supply pointed to higher chip prices and better profits ahead. Samsung's announcement of increased investment in domestic chip making signaled confidence in long-term growth. Investors cheered, seeing this as a proactive move to cement market leadership. Fresh data showed South Korea's exports rising and imports falling, a healthy sign for its economy. The combination of industry optimism and strong trade data created a rare bright spot in Asia. Even as most markets fell, South Korea's chip sector reminded investors of the power of company-specific news. It was a lesson in how resilience can emerge even in tough times. Elsewhere in Asia-Pacific, markets painted a mixed picture. Australia's ASX 200 slipped 0.3%, weighed down by concerns over China's slowdown and commodity demand. Singapore's Straits Times Index edged down 0.1%, mirroring the region's cautious mood. Both markets followed the lead of their larger neighbors, with little domestic news to change the trend. In contrast, India's Nifty 50 rose 0.3%, buoyed by strong local growth and foreign investment. Indian investors focused on domestic positives, shrugging off regional worries. The divergence highlighted Asia's diversity. Local factors still matter, even amid global headlines. Each market responded to its own mix of influences, from commodities to tech to domestic growth. The day's trading showed Asia is far from monolithic. Each country charts its own course. As the trading day ended, investors faced a landscape shaped by caution and complexity. Japan's economic contraction and Nvidia's looming earnings set a risk-off tone across Asia. The week ahead hinged on two questions. Would Japan's central bank shift policy, and could Nvidia sustain the AI rally? High-profile investor exits from Nvidia added to the uncertainty, making its earnings a global event. Meanwhile, South Korea's chip rally showed the value of focusing on industry fundamentals. Macro and geopolitical headlines will keep driving sentiment, but sector-specific stories will determine winners and losers. For investors, the message was clear. Volatility is back, and navigating it will require vigilance and adaptability. The week ahead promises more twists as markets search for direction.